Welcome back to NYSE TV Live. As we enter the first trading day of June, the S&P 500 is coming off its best month since November of 2023, climbing by more than 6%. However, a busy month of June awaits, ranging from tariff negotiations to this week's jobs data and a looming Fed decision on June 18th. Joining me now for more on the markets is Kevin Gordon, Senior Investment Strategist at Charles Schwab. He joins me here at the desk. Kevin, great to see you.
Morning. Nice to see you.
Thanks for kicking off the month of June with us. First trading day about to be underway in almost 15 minutes here. We teased our interview by saying, can the rally continue? What do you think? Can the May momentum carry into June? Futures not necessarily looking like it today.
Yeah, there's a little bit of a stumbling, I think, after such a great month. Best for many sectors since 2023. But I think the next phase that we're going into after kind of getting through, that initial bounce off of the April lows, but and you kind of started to see it over the past couple of weeks. But after that really strong bounce, now you're just kind of going through a grind. That's what it's been for many indexes and many sectors over the past few weeks. And I think it's because we've taken out and sort of priced out the imminent recession risk that you had post-Liberation Day in the immediate aftermath. Now you're getting to the phase where you have to really start to price in what is the expectation for growth and inflation and also the labor market because of this new mix of having to negotiate multiple trade deals with other countries, seeing where the effective tariff rate ultimately lands, and for which countries and for which sectors. So there's a lot that still needs to be moved through the market or economic python, but I think the market pricing over the past few weeks is reflective of that. So to me, this sort of on again, off again kind of grind sideways makes sense for now, especially as we now, start to, as analysts and strategists, we start to really look at and sort of tally what the ultimate impact is to earnings for companies.
How are you thinking about the impact of tariffs, though? Because we still don't have a lot of certainty on that front, and as we've seen with the headlines coming out of the U.S. and China, the tensions seem to be ratcheting higher and the relationship seems to be deteriorating a bit. But at the same time, we've recovered the Liberation Day, from 20% from the lows, and we don't really have any deals yet aside from the UK.
Well, it's interesting. The market has become almost desensitized to headlines as we've gone on, as time has gone on. I think even for something like China, it's an important trading relationship for sure. But when you look at the direct trading relationship as a percentage of overall imports, if you want to measure it that way, it's come down, markedly over the past several years. Even if you date it back to Trade War 1.0, when it was during Trump's first term. So our direct dependence on China has gone down as it's shifted to other parts of the world, importantly Canada, Mexico, and then other parts of Southeast Asia. So that, to me, I think as a block, if you were to look at the rest of the world ex-China, is probably more important to focus on in terms of where tariff rates ultimately land. The China situation has been almost its own isolated issue apart from every other country at this point, even for Liberation Day tariffs, that rate going up to 145%, 150% and change was clearly putting China in a separate pack. So I don't think that, relations or talks breaking down with China in particular is going to move the market that much. You can even see we're off the lows, from this morning for futures. But that's an important trading relationship to watch. To some extent, it is sort of a bellwether as to how overall talks are going. But to your point about having to do this with multiple countries, having to figure out where the ultimate tariff rate settles, that is the part that's going to take a while for this to feed through. And it's the sort of the ultimate unknowable in terms of the effects on inflation, because you can point to that one level price increase that stems from tariffs actually going into place. But if there's retaliation and if there's a back and forth, that's what becomes inflationary. So that's what ultimately keeps the Fed in a bind in terms of figuring out where to move on policy.
So as you think about what gets the market out of the grind that we could potentially see based on how far it's already run, what is it?
I think, it probably boils down to some extent to earnings because, we've now gone through 2 consecutive quarters where earnings growth, the bar for earnings has been lowered so much at the beginning of the quarter, at the beginning of the reporting season, where estimates were down in the single digit, kind of, low to mid single digit range. And then as you went through reporting season, companies surprised significantly to the upside. And so it created this really strong, what we call, the earnings hook, where you start low and then you end up really high. You beat the bar, market gets relatively surprised. That ultimately helps, the overall aggregate stock market. I think if you go through that again, because analysts have become somewhat pessimistic and they've lowered their forecasts so much, maybe that becomes a little bit of a jolt of energy. But I will say, in the most recent reporting quarter, even though you had companies that were significantly beating on the top and the bottom line, that actually wasn't enough to lift their stocks by as much as has been in the past. It was still an overall positive surprise, but that, again, it's sort of you talk about desensitized, the market's reaction to trade headlines. There's sort of a desensitization going on with the market's reaction to positive earnings beats. So I think that means that the guidance part becomes more important.
And
so
wasn't
whether you're
enough for
issuing
you
guidance,
to change your neutral stance toward every
exactly.
sector in the market. So just quickly, we have about a minute left. Tell me, how are you advising investors to really invest in the current market?
Yeah, I mean, the neutralization call for sectors was mainly because, similar to the pandemic lights off, phase in 2020, nobody really had any clarity as to what sectors were going to benefit the most. We find ourselves in a similar situation now. As time goes on, we'll be able to figure out, as we get a little bit more clarity on trade, we'll be able to figure out which sectors are kind of more exposed and probably going to see weaker recoveries. But our guidance has been more on the factor and the characteristic side of things, because even if you look at, companies that have been seeing significant upward earnings revisions, that have seen sales revisions go higher, that have relatively high interest coverage ratios, all of those higher quality characteristics have been outperforming in the market. But that's not specific to a sector. So it's not that you're only finding that in tech or you're only finding that in industrials. You're finding it in every sector. It just depends on where you can find it and where you're looking as an investor.
Okay, we'll leave it there.
Yeah.
Kevin Gordon, always appreciate your insights. Thanks
Good
so
to
much
see you.
for joining me
Thank
today.
you. Thank you.
That's Kevin Gordon, Senior Investment Strategist at Charles Schwab.